Google's cloud business grew 82% in a single year. Yet that quarter, Alphabet reported nearly $6 billion of negative free cash flow. Demand was booming. The infrastructure bill reached almost $45 billion. And Google was only one company in the race. Amazon, Microsoft, Meta, and Alphabet have each committed to unprecedented capital spending during 2026. Add their latest guidance together, and the range runs from $710 to $740 billion. The midpoint is $725 billion. That is almost $2 billion every day, or roughly $23,000 every second. The exact total will move because these companies define capital expenditure differently. And not every dollar goes exclusively toward artificial intelligence. But artificial intelligence is the force pushing the spending race into unfamiliar territory. The revenue and customers are real, and demand is still accelerating. Yet cash flow and margins are already absorbing the cost. This is not simply another technology bubble waiting for a dramatic pop. It is a financial prisoner's dilemma, where slowing down may be more dangerous than overspending. Microsoft says its artificial intelligence business now exceeds a $37 billion annual revenue run rate. That figure more than doubled in 1 year. Amazon Web Services generated nearly $38 billion of quarterly sales, growing 28%. Google Cloud grew even faster, reaching almost $25 billion in 1 quarter. Meta's advertising machine delivered more than $56 billion of quarterly revenue. So the companies are not spending into an empty market. Microsoft added an entire gigawatt of capacity in 1 quarter and still expected shortages. Amazon says customers have already committed to a substantial share of future capacity. Every unavailable server represents a customer who may choose another cloud. Every delayed data center gives a rival more time to control the next computing platform. That fear turns demand forecasting into an arms race. If one company builds cautiously while the others build aggressively, caution can look like surrender.
Amazon believes this resembles the first great expansion of cloud computing. Spend first, absorb the cash flow pain, then monetize the installed capacity for years. But this cycle has a dangerous difference. Much of the newest equipment is short-lived, expensive, and improving at extraordinary speed. The race is not only to build the largest machine, it is to earn a return before the machine becomes yesterday's technology. A cloud invoice begins long before a customer runs the first workload. First comes land, sometimes purchased years before the first server arrives. Then come permits, power contracts, transmission connections, and water or air cooling systems.
Transformers and switchgear must be ordered from factories already struggling with long backlogs. Only then can racks, networking equipment, storage, and accelerators move inside. Amazon says this cash can leave 6 to 24 months before customer billing begins. That delay changes everything. The company pays during construction, but the revenue appears only after capacity becomes operational. Some assets, like buildings, can produce value for decades. Others, especially chips and servers, live on a much shorter financial clock. Microsoft says roughly 2/3 of 1 quarter's capex went to GPUs and CPUs. Those are the assets expected to create revenue fastest. They are also exposed to rapid improvements in performance, energy efficiency, and price. Microsoft faces the same incentive, Control more of the stack before shortages or prices control the business. The companies are not merely building data centers. They are rebuilding the economic stack, from electricity to silicon to software. Each layer offers an opportunity to lower cost. And each layer creates another place where delays can trap billions before earning a dollar. To understand the risk, forget stock prices for a moment and follow the cash. Operating cash flow measures cash generated by the company's operations. Capital expenditure measures cash invested in long-lived equipment and facilities.
Subtract the second from the first, and you get a common definition of free cash flow. Profit can remain positive, while free cash flow falls sharply. That is not automatically deception. It is how heavy investment reaches the accounts. Amazon generated $148 billion of operating cash flow over 12 months. After its stated capital spending calculation, only about $1 billion remained as free cash flow. 1 year earlier, that figure was nearly $26 billion. If those workloads arrive, today's construction becomes tomorrow's cloud revenue. But if prices fall faster than utilization rises, the expected return narrows. And while cash leaves immediately, accounting expenses arrive gradually through depreciation. Alphabet raised almost $50 billion through equity and another $20 billion through senior notes. Its filings list broad corporate purposes, including infrastructure and global computing. That financing does not prove Alphabet was unable to fund ordinary operations. It does show how capital-intensive the new computing era has become. Even the richest technology companies are redesigning how they finance growth. Alphabet's second quarter looked spectacular from the top of the income statement. Revenue approached $120 billion, while operating income exceeded $40 billion. Google Cloud grew 82% and produced nearly $9 billion of operating income. Then, the cash flow statement revealed the cost. Operations generated $39 billion of cash. The resulting free cash flow was negative by nearly $6 billion. Alphabet then raised its reported annual capex range to as much as $205 billion. 1 quarter cannot prove the investment will fail. But investors are being asked to accept a larger bill before the full return becomes visible. Microsoft faces the same tension inside its margins. Cloud revenue is expanding, while infrastructure and growing usage pressure gross margin percentages. Short-lived chips may produce revenue quickly, but their cost does not disappear. Its advertising business still generated enough cash to fund the race during the first quarter. The question is, what happens when construction, depreciation, and replacement spending all rise together? Found analysts expect 5 hyperscalers could spend more than their combined free cash flow by 2027. That is a forecast, not a fact. Money is not the only limit. American data centers consumed about 4% of national electricity in 2023. The Energy Department says their share could reach nearly 12% by 2028. Globally, the International Energy Agency expects data center electricity demand to roughly double by 2030. Producing electricity is only one part of the problem. Reuters reported that some generator transformer lead times had stretched beyond 160 weeks. High-voltage circuit breakers were taking as long as 125 weeks. A finished data center without a grid connection is not infrastructure. It is an extremely expensive, dark building.
Political pressure followed as communities worried about electricity prices, land, and water. Technology companies joined a voluntary pledge intended to protect ordinary ratepayers from data center costs. A pledge is not the same as a guaranteed outcome. But its existence proves the infrastructure race has escaped the technology industry. It now reaches utilities, factories, governments, and household power bills. The next great computing bottleneck may not be a chip. It may be the grid itself.
Calling this entire build-out a failure ignores real revenue, real customers, and severe capacity constraints. Calling it guaranteed success would be just as dishonest. The winners must keep their expensive machines full, lower the cost of every computation, and defend pricing power. They must secure electricity, deploy hardware quickly, and convert construction into billable capacity before technology moves again. Amazon is betting on customer commitments and custom chips. Microsoft is betting on cloud contracts, software distribution, and an integrated platform. Alphabet is betting that search, cloud, and consumer scale will monetize the infrastructure. Meta is betting its advertising engine can finance the path toward new products. At least one of them may spend too much. Yet none can confidently spend less while competitors race ahead. That is the real danger inside a $725 billion arms race. Not that one company may lose, but that none of them can afford to stop running.